Good morning and welcome to our look at the Bank of England meeting from yesterday. The Bank of England meeting was yesterday at 12 o'clock. We saw a 0.25% increase in the base rate. That's obviously the main kind of headline number there. You can get that from anywhere. Obviously, what we're trying to do is dig a little bit deeper into the figures, dig into exactly what the Bank of England is really focused on moving forward, and exactly what that means for sterling assets, for sterling markets over the course of the next 3, 6, 9, 12 months, and obviously over the course of the forecast period, the next 2 years, certainly in regards to both inflation and growth. For those of you who don't know me, my name is Jeremy Thompson-Cook. I'm the chief economist and one of the senior portfolio managers here at Audere Solutions. I'll touch a little bit, obviously, on what we do here at Audere Solutions, but the reason why you're likely here is to hear about what we think the Bank of England meeting actually means. So let's get into that as soon as we can. Just to let you know, this is being recorded for compliance reasons, but also so we'll be sending out a link to the recording later on in the day. So feel free to come back to it if needs be. Perfect. How did the Bank of England see the UK economy in Q1? It's always good to make sure that we are marking their homework, as it were, against what they previously said. Now, if you're able to remember, cast your mind back to kind of November or February of this year, there was lots of talk about multi-quarter recessions here in the United Kingdom, that we would see negative growth out till some point in 2024, and that also inflation would remain high but start to come a little bit lower. A lot of that thought has come out of the Bank of England's latest round of expectations. In fact, these kind of 4 things that I've put on this slide here were the key kind of takeaways that everyone took from the MPC report back in February of this year. So let's go through them one by one. It simply states that inflation was high. It was over 10% heading into or through the mid part of Q1, heading into Q2. But it was said to fall as base effects increased, i.e., obviously it's a 12-month look. So as it becomes continually high for 12 months, then the the year-on-year inflation has definitely fell. And then gas prices have fallen. Unfortunately for the MPC, that has not proved to be correct as yet. In fact, inflation still remains high. We haven't seen base effects come through, and gas prices, while they have fallen, are not having too much of an effect. So we're going to have to put a fairly large cross against that first one. Growth was expected to remain poor with the prospect of a multi-quarter recession still high following a collapse of investment and consumer spending. That has also proved to be incorrect. The UK economy, we saw the Bank of England revise their growth estimates higher yesterday. Away from a recession, there is currently no prospect, according to the Bank of England, of a recession, to be honest, from most commentators now as well. So would have to say that is another cross on the Bank of England. And then unemployment was expected to increase as businesses prepared for the forthcoming recessions, in turn also allowing for a decline in wage demands. We have seen a little bit of a softening, but certainly not in the kind of areas that we would expect. So that, unfortunately, is another cross. Whoops, I'm not very good at these crosses, am I? We're not seeing that kind of level of uncertainty from the jobs market. We also have to remember that businesses don't really like firing people. And it's, while US tech firms have come in for a fair bit of flack over their ability and desire and ease, which they've cut tens of thousands of workers in the UK and in the EU as a result of EU kind of labour legislations, it's quite difficult to get rid of people. So we haven't seen a big fall off in jobs, and that's not contributed to poor consumer spending. The last point is not really, we can't really mark it as kind of a tick or a cross. The Bank of England's base rate was expected to peak at 4.5%, i.e. the level that it was raised to at yesterday's meeting. It's still too early to tell as far as that goes, to be honest, as it were, because at the moment, while we expect, and I'll kind of cut to the conclusion a little bit early, while we do expect that the base rate here in the United Kingdom has now peaked at 4.5%, and that the next move by the Bank of England will most likely be a cut, we could easily see some form of rise next month. But for now, as it stands, we do believe that the Bank of England's base rate has peaked at 4.5%, and nothing will happen now to the high side as part of this rate hiking cycle. So too early to tell for now. We'll come on to the reasons why later on in the presentation. So that's where we stood. As far as the February outlook from the Bank of England, they kind of got out of 3, you'd say 0 out of 4, maybe a half point. Are too early to tell, but moving forward, all the news that's come out of the Bank of England has actually been a little bit more optimistic, and that's obviously something that we are happy with, given we live and work in the United Kingdom. A lot of our clients are based in the United Kingdom or have sterling assets within portfolios, or sterling as part of their risk hedging profiles. All of this makes things just a little bit easier. We don't like trading through recessions. We like trading through growth, and certainly if we're starting to see a slight pause, if I could put it that way, in the interest rate movements from major central banks, it also makes analysis a little bit easier as well. But we do have to focus on risks, because there are still risks going on. I've really drilled down on 2. We've only got half an hour. I could go on for probably hours about all of this, and I'm not going to. But I've drilled down on 2. One is gas and one is growth, the 2 Gs that we are looking at from the UK economy moving forward. Inflation and energy prices, and particularly gas prices here in the United Kingdom. Since February, since I'm staring out my window and it's not particularly warm here in London today, but since it has started to pick up in temperature, both in the UK and in Western Europe, post the winter, since February, spot gas prices, so gas to be delivered immediately, has declined to below the level seen before Russia's invasion of Ukraine. However, we're still above the long-term average that kind of was in place between up to mid 2021. And as you can see here from this graph that is actually pulled from the Bank of England's analysis itself, the forecast assumptions by the Bank of England have also moved lower. They're now that pink line, May 2023. So while still elevated compared to, if you look back at that graph, 2019 into 2020, while still elevated, you're looking at 100 pence per therm, or 150 pence per therm, versus 40 or 30 or 40 previously, and obviously we got up to highs of over £5 per therm. In the grand scheme of things, we are a little bit lower. It's not having that much of an effect. The push through as well is also something that's quite interesting. Consumers, we were of the opinion that consumers would really be hit hard by energy prices, and there still is the possibility, because the energy price guarantee does, we have seen some form of an extension, but it's not a huge extension. Whether we head into winter this year, the government, for whatever reason, does not feel comfortable helping households and businesses out with energy bills. There could be another inflationary spike later on down the line, but in the grand scheme of things, at the moment, it's not something to be overly worried about. But in the medium term, we have to obviously mark it down as a factor that could obviously make some form of volatility in inflation, therefore volatility in rates, negative externalities on UK growth, and in the grand scheme of things, therefore a negative for the pound. As said here, significant uncertainty remains around the outlook for wholesale energy prices. I'm not in the business of, I'm in the business of forecasting currency. I'm in the business of helping corporates mitigate risk. I am not an expert on war. And in the grand scheme of things, as far as Russia's invasion of Ukraine, there were obviously markers that it would happen, but it took a lot of people by surprise, not least markets. And so therefore, we have to remember that while we could see obviously and hope for a de-escalation of the conflict in Ukraine as a result of Russia's invasion, there could also be some form of escalation as well, and that can obviously have huge effects both on pricing but also on economic output. Let's put it that way. So for now, we do expect gas prices to obviously pick up, as you can see here from that May 2023. There is an increase as we hit the winter, the hump of winter. It's seen as a quicker pickup than it was in 2023, but to a lower level, which is interesting, both from an inflation point of view, but also from an overall spending point of view as well. And something to bear in mind when you hear people on the news or you hear politicians talk about energy bills, they are going to continue to increase, but maybe just at a slightly slower rate than they did previously. So something to bear in mind if you're still paying your gas bill here in the UK, or if your business has operations in the UK, obviously, and therefore energy prices you're having to factor into your kind of UK operation P&L. Growth is really, really interesting in the UK, and this is probably the second. Well, this is the second G risk that we have for the UK economy. Is as I put here, it's kind of Dr. Strange growth, or how I learned to stop worrying and love the economy. At the moment, there is a lot to be said around resilience within the UK, and certainly resilience. Resilience of the UK consumer. The US consumer is probably the biggest economic force in the world. The UK consumer, we love spending money. When the going gets tough, the Brits go shopping. That's what I've always said about the UK. There's very, very few places in the world where Boxing Day isn't spent with your family. It's spent with strangers in a department store looking for something which is 30% off. As it stands, the UK consumer is proving to be incredibly resilient to the pickup in prices, stagnating wages, a little bit of uncertainty around their jobs, and obviously a fall off in the buying power of their wages as well. In the grandest scheme of things, you would expect to see people pull in, maybe tighten their purse strings a little bit. But we are in a slightly strange position here in the UK at the moment. We've had a huge amount, a number of bank holidays, particularly the one this week even, for the King's coronation. We are expecting that spending on food and drink will have picked up over the course of Q2. The weather's picked up. People like spending money on leisure, barbecues, that kind of stuff, and so we are expecting that to have picked up. But we have to remain cautious over the ability of UK consumers to continue this level of spending, because where's the money coming from? Is it coming from wages? Well, we know that real wages are actually falling because inflation is higher than average wage settlements. So are people running down savings? The savings data isn't particularly strong at the moment, i.e. people are not putting away much money in the form of savings. So are they either running down savings or contributing less to their savings to keep their standard of living at a similar level? Or secondly, are we seeing people take out credit? Are we seeing people borrow to fund this lifestyle? Are we seeing people take out 0% credit cards, for example, extend overdrafts, take out unsecured or secured loans to be able to buy the car, do the house up, or whatever it may be, go on holiday, whatever it may be? That data is still yet to come out, and will prove to be very, very interesting, because politicians always say there's no magic money tree. And it does seem in the past Q2 that Brits may have found maybe not a magic money tree, but certainly some form of magic money shrub that has allowed them to continue a pull through of spending that is allowing the UK economy to move away from thoughts around a recession. There's other things as well. Government spending, the changes around the budget have also helped out with certain things. We expect their input to the UK economy to be a little bit more than previously, but but if you take everything in the round, we are expecting a more positive look to the UK economy than we were 6 months ago. And as you can see from this fan chart, and to be honest, this fan chart is, it's a useful chart. It's not as useful as it used to be because of the huge moves that we saw as a result of COVID and the unwinding of the lockdowns. We saw 20 to 25% increases in output on a year earlier numbers, which you'd never see. You never see outside of a war or a global pandemic. So the scale is somewhat squiffy as a result of that, but we are now expecting growth to remain positive all the way through the 2-year forecast period. That being said, it's not particularly bold growth. You're looking at 0.2 to 0.9 as a kind of average between those quarters. Nothing really over 1%, which is where you'd really want to be, certainly in the still form of some form of recovery from a global pandemic. But as it stands, the fact that it's not negative is a good sign. What it does mean for rates, though, is are we in a very, very awkward period where a recession naturally means that you're probably likely to cut rates. Inflation is still high, so the bid to or the need to maybe hike rates is also high. So which way is the Bank of England pulled? Which way do we think they're going to go? Do they side with inflation? Are they still worried about growth? They have a mandate for inflation. They don't have a mandate for growth. So what does it really mean for sterling assets? And at the moment, we think what this means to the MPC, to the Monetary Policy Committee, is that we will see some form of hold by the Bank of England, that we will not see further movement of rates, and the next movement of rates from the Bank of England will actually be a cut. And I'm not expecting that this year. It'll be next year, but for now, rates are on hold. So where now for sterling, and where now for rates? There is a risk to the downside in the longer term, and I'll come on to why as we move through this slide. But sterling reacted negatively yesterday. I don't think that was anything really to do with sterling. It seemed to be more of a dollar move. So people out there saying, oh, it's as a result of people pricing out interest rate hikes and things like that. That will happen. That is going to have to come, but it didn't happen yesterday. And I don't think it was anything to do with the broad energy that the Monetary Policy Committee was putting out. The vote yesterday was 7-2. 7 people voting for a 25 basis point hike, 2 voting for a hold. While 7-2 is still obviously a fairly not unanimous by any stretch of the imagination, but still a fairly overarching win for the team that wanted to hike, and obviously we could get closer to 6-3 or 5-4. As it stands now, we think that more and more people will be looking to hold at the next meeting. That doesn't rule out the possibility of a hike next meeting, but we do think that more people could move towards the hold camp as the course of the next quarter goes on. Reasons why. Inflation is what the Bank of England's mandate is all about: controlling prices, keeping the prices stable. And over the forecast period that the Bank of England puts out, which is a 2-year period, they would naturally try and see inflation down to a level that's close to their mandated target, which is 2%. So over the course of the past years, they've been putting out inflation and growth expectations. Last year, inflation expectations were kicking higher, way above 2%. They were having to hike rates, and that made perfect sense. But now inflation expectations, if rates stayed as they are, i.e. where they moved to yesterday, 4.5%, are for inflation to actually be below target, 1.8%. Now, they were surprised by the UK economy's resilience around UK's resilience around growth through Q1 and the Q2 that we've had so far of this year. Fine, but to me that looks like an MPC that's sitting there and saying, okay, if everything goes on the forecast path that we are expecting now, i.e., including that new optimism, inflation is still going to be just a little bit below target, then I think we're one hike or maybe 0 hikes away from a hold. This stands against what a lot of people in markets are thinking. Markets are still pricing in 38 basis points of hikes. 38 is 1.5 essentially. So 25 basis points at the next meeting, and then 12 or 13 basis points from the next meeting, i.e. a 50-50 split about whether we see another hike moving forward from there. So if they're pricing in a hike or 1.5 hikes by the end of the year and it doesn't happen, that would naturally lead to some form of softening of sterling, a softening of sterling assets, because as it stands, you're not getting that yield, you're not getting that payout of that increased rate. You know, the Bank of England base rate being at 4.88%. Alongside the noises that we're hearing from the Eurozone, alongside the noises that we're hearing from the United States, we don't think the Bank of England wants to be leading anything higher. Eurozone, maybe. Fed, given the banking situation, definitely not. So you'll probably say of the more bullish central banks out there, ECB's at the top. There's a big gap, and then it's the Bank of England, and then it's the Federal Reserve. So for now, we think that as we head into Q3, the Bank of England will start to guide against further interest rate hikes. That may not be particularly explicit at the beginning, because yesterday they were very much about it could go higher, it could go lower. But I think that as we head into Q3, and certainly if the growth story does stay resilient, they'll be more and more comfortable to be able to do that, that actually we will start seeing people talk about a cut being the next move. We want to say that, we want to be the first ones to come out and say the next move from the Bank of England will be a cut, and we think it will be next year, and we think it will be next year, May. So rates will stay roughly where they are now, 4.5%. Obviously, there's a not insignificant risk of a hike next month to 4.75%, but we think that's we don't think that will happen, and therefore the next move by the Bank of England, as said, will be a 25 basis point reduction in the base rate May of next year. There's a lot that can happen between now and then. As I said, a huge amount of risk out there, a huge amount of uncertainties around there, which will affect everyone from financial markets to businesses that are just thinking about setting up, let alone ones that are set up now. I wanted to quickly touch on what we do here at Audere Analytics, the work that we do here, and how we help businesses who are trading internationally. We know, and I've worked in FX for, as you can tell from the grey in my beard, far too long. But we know that this market can seem quite scary to a lot of people. It can seem overly complicated and particularly opaque to a lot of people, certainly around the ability to trade and hedge yourself appropriately, and the pricing that you're able to receive on those kind of products. Spreads can be hidden. Even hedging advice can obviously be misdirected. There's a real lack of advice from these parties, and certainly if these parties are willing to give advice and do give advice, there is always the caveat that obviously if they are doing some form of execution around that advice as well, that advice is also helping them, maybe more so than it's actually helping you. The sales process is very is pressure intensive, is pressure focused to try and get you to make a decision. As I said, it really does in some points lack transparency. What we have done is put up both a traditional but also an innovative solution to this, being able to stand there as consultants, completely independent from workings within this market, but also with a technological solution to be able to put it into very clear and contrasting terms to allow you to make fully informed decisions around currency, interest rates, and commodities, and whatever that means for your business, whether that's a small amount of payments every day, a huge amount of hedging, just looking at hedging, forwards, options, whatever it needs to be. I say it's an independent and impartial operating model. And at the end of the day, the best thing for us is for a business that comes into the process and leaves more informed and more in control of the risk that it may have, as opposed to one that is simply simply just dealing with a bank or a broker because that's how they've always done it. If you'd like to speak to us around a demo of our Audere platform on a completely complimentary basis, as say on a no commitment basis as well, then obviously feel free to get in touch. We've got a little bit of time left for, well, the next slide is just the disclaimer, so I'll leave that. But as far as we do have maybe a minute or two for questions. So if anyone has any questions, feel free to type them into the chat box, and I'll happily answer them for you now. Okay, first question has come through. What do you think about sterling against the United States dollar and the euro over the course of the second half of the year? Cool, interesting question. Euro's really kind of bulling up, I think, at the moment, and we're starting to hear a lot more people get on side with the European single currency as a currency moving forward. So while I do believe that sterling value is underrepresented at the moment, I think that people are more happy to take on the euro as a portfolio currency moving forward than the pound. So I do think that euro sterling will probably trade towards 90.9 over the course of Q3, maybe into Q4. Certainly, if the Bank of England proves that this is a hold, and therefore that 38 basis points of tightening does fall out of the mix a little bit. Dollar's really interesting as well. I can't look past two things in regards to the US dollar. Banking system at the moment and the issues that they've had around those three banks that have not so much gone to the wall but had to be picked up by other people. But also, secondly, the conversations around the debt ceiling, and the debt ceiling could have the potential to blow a lot of this out of the water because of the kind of political showdown that we are expecting in Washington over the course of the summer. We do have a little bit of wiggle room, a couple of weeks between now and when it will really start to get spicy, as some people say, and that will prove a real negative for the US dollar moving forward. So sterling dollar back above 125, can easily see that. I don't think 130 is out of the question in the longer term, but we'll wait and see. But yeah, euro sterling towards 0.9. One thing I also want to touch on as well, which I put in the slide but I forgot to mention, is if we do see sterling, the Bank of England hold rates, and the ECB and the Federal Reserve maybe pop a couple more hikes in, certainly the ECB could easily do that, then the forward points, the hedging costs that you are paying on forward contracts and on options are going to change a little bit, and that may make it a little bit more expensive for you guys to be hedging over the course of the time periods that you're looking at. So if you want to get in touch, have a conversation around what that means for your business, or what it may mean for some form of hedging portfolio that you already have or want to put together, then get in touch, because it's something that a lot of people, especially in the broker market, will not be looking at. So get in touch, we'll have a conversation around what it means for you, we can work it forward from there. Perfect. If there's no more questions, and I said I would try and keep it to half an hour, and I've kept it to 29 minutes, so that's worked out pretty well. We will be putting this recording online. We'll also be sending out a link to it, so feel free to watch the recording and and obviously come back with any questions that you may have. It's always great speaking to you. It's nice to see some familiar faces, nice to see some new ones on the call as well. Thanks very much for taking the time. I know obviously you're really busy, so feel free to get in touch when you can. For now, have a great Friday, have a great weekend, and we'll see you next month.